Good afternoon. My name is Ken Scornia, founder and CEO of Krilogy. I'm here with my partners, John MacArthur, our Chief Investment Officer here at Krilogy, and Brian Fernandez, our new partner and president of Krilogy. Brian, welcome aboard.
Thank you, Ken.
It feels like you've been here for a long time because we've known each other such a long time, 10 plus years. We met each other at an organization called YPO, Young Presidents Organization. We met because you ran a large family office for quite some time. You have experience, 25 years experience in the high net worth, ultra high net worth space. Before that, you were a practicing attorney. Before that, you were in public accounting. You've seen it all. We're excited to have you.
Thank you.
One of the reasons why we wanted to get together today is to introduce Brian and really the concept of the family office for our Krilogy clients, what that means, how that relates to everybody inside the organization. As Krilogy's services continue to expand, as you all know, over the last few years, we started with a deep investment philosophy, a deep team. We really worked hard on the wealth management space, but then opened up the tax group that did our clients' taxes returns and did a lot of advising in the tax space. And then our law group, our affiliated law firm, Krilogy Law, which was really working deep on our clients' estate planning piece. So as those services continue to expand and your assets, our clients' assets continue to accelerate in terms of net worth, we needed to continue to stay ahead of the curve for them. And that's one of the reasons why we wanted you to run our family office services space. Brian, give us a sense when we say family office, what does that term mean?
So within the industry, there's really a wide scope what that looks like, Kent. There's a single family office world that's existed for hundreds of years, but there's a multi-family office that's evolved over the last probably couple of decades. Within that, the major definition probably predicates on just really complexity. So as families increase their net worth, there's just more issues they have to navigate and deal with. And instead of their normal jobs in daily life, they now have a new business called the business of their family's wealth. What that looks like is all of a sudden it may be some general issues that you might have if you have $1 million, but up to $1 billion, the frequency of those issues, the complexity of those issues, and really the depth of what you need help with is greatly increased. For instance, with the investment side, you go from having simple stocks and bonds to universe of all sorts of private investments. On the estate planning side, you might have a basic will and trust, all the way to extreme wealth transfer strategies you have to deploy. So is in tax savings, partial advocacy. So it really just gets to the level of how much more and the frequency of those items. Instead of something you might deal with annually, and now it becomes monthly and weekly. And importantly, as a family office, you need somebody to help you spot those issues and help you kind of coordinate those issues and narrow those down to just a few decisions you have to make, as well as bringing in all the outside tax and all that you talked about. That's really what the definition might look like.
Love it. And John, as you're helping implement large portfolios for these families, give us a sense of what they might be doing that might be a little bit different than sort of the retail investor.
Yeah, I think there's a couple key themes, Ken. I think the first would be the after-tax nature of investments and the focus around that. Not only tax savings, but tax favorable vehicles broadly speaking. I think the other, as Brian touched on, the focus on private markets. Private markets, everything outside of public equity and public bonds has evolved significantly. For perspective, there's nearly 13,000 private equity-backed companies, and the universe of publicly traded stocks is 4,500. So the sample set is just frankly larger. That's only one segment of private markets, that private equity example. So,
and they might have the opportunity to do that because they do not need the liquidity at all times when you're talking about portfolios of that size.
Absolutely. If we can solve for the income piece for a family, then, from the risk budgeting perspective, you have more capital to think long duration, to think of what can complement my public equity portfolio as kind of a long-term growth engine over time.
And that will particularly coincide, Brian, with, the strategic plan and the entire arc of the family evolution in terms of how the portfolio navigates inside their strategic planning piece.
So an evolution is a great word, Kent, because really when you talk multi-generational, you now have a 10-year time horizon that might be 50 years instead. And so back to John's comment on liquidity, you have more options. You have things that are focused more on growth versus current income, which you're worried about your kids or grandkids down the line.
And tell us about how you help. You just mentioned multi-generations, right? You might have a matriarch, patriarch, Gen 1. Tell us how you've interacted with the next couple of generations from there and how complex that can get.
So importantly, there's been a lot of work done in this area over the last 30 years, but prior to that, there was very little that was done. And what we learned through that was really just the lack of communication to those next generations became a hindrance. And maybe the success of passing that wealth along. And one of those issues we come up with is people work really hard to achieve this wealth. How do we prepare the next generation for that? And what's come to mind is it's no longer just about the financial piece. It's also about the non-financial piece. So there's some work you'll hear about financial capital, but non-financial capital also, which is the human capital of the family, intellectual capital of the family, social capital, or spiritual. And what we've understood now is it's an interrelated ecosystem, and making financial decisions based on all of that is really beneficial within a system of family that may have some different opinions about how things can look longer term.
I thought it was interesting. You and I were in a conversation the other day about leadership in a family and how, who's the dedicated leader of the family, much like you have a leader of an organization. John, you and I have helped a lot of our clients educate their children just on the investment side, or maybe on some basic financial planning topics. But when you're talking about multi-generations, 2, 3, 4, 5 different sets of family, it takes a little bit more unique approach than the ad hoc way we've been doing it for some time.
There's no question. I think what we found too is if you look at just one family with 3 siblings, the likelihood that each of them needs the same amount of data and the same passion, and really that they might have the same goals, is pretty unlikely. And so how do we kind of meet each of them where they want to be, but still thinking about that overarching family, making sure they're one cohesive unit if possible.
And John, we spoke about earlier the private, the options on the private markets out there, and how many more opportunities there frankly are in terms of finding return, yield, etc. How does getting access to those things from the ultra high net worth space, the family office space, allow us to actually implement some of those portfolios to the rest of our client base, which I think is a huge leverage point for us?
Yeah, those market segments on the private side tend to be pretty inclusive and closed off. So if you're not kind of in that ecosystem, then access and sourcing and those types of things become really challenging. So we've been really intentional with our partnerships and our focus around creating relationships in that space for a number of years now. So that's really key. I think having relationships and having co-diligence partners and those types of things in order to get access to opportunities that frankly, either don't exist, for the broad investment public, or they exist if you're willing to produce a really large check, and that doesn't make sense from our diversification principles and
right. Or they exist if you're willing to pay a really high fee.
Exactly. Yeah,
that's right. Let's stay on the economy and the markets for a little bit. What your team's seeing out there right now? There's a lot going on. We've sort of had a really unique year in terms of, the markets that hit all-time highs multiple times. In April, we had, pretty dramatic drop. What are you guys seeing right now?
It's been a really interesting year. The year really started with kind of this outperformance, in conjunction with a weaker U.S. dollar. Outperformance from international assets, that is. That really subsided kind of at the midpoint of the year. In the June-July period, we really saw this kind of reinvigorating move from a lot of the non-profitable, very high beta, very high growth segment of the market. Literally within the last week or so, that has begun to cool off. So, I think when we step back from all of it, I would say that it's very reasonable to expect some type of softening or a corrective move at this stage, not only seasonally, post-election period, but the sheer fact that the S&P is up about 32% from the April lows. So a normal cooling is expected here as we work through the next couple of months. Jamie Setley, our director of technical research, has identified, if I were to throw out a level, 5,900 on the S&P would be about a 9% drawdown from peak. I'm not suggesting we get there, but that would be very normal in the context of the move that we've seen. There's a lot of confluence from the technical analysis and checkpoints that he pays attention to. Again, that's an area that is of interest to us. Doesn't mean it'll happen, but that would be a good level of support. I think the other thing I would just identify is that, if we look at the top 10 stocks in the S&P, 35 to 40% is the market cap of the S&P from just the top 10.
Yeah. Speaking of market caps, What was a stat we all just spoke about yesterday about NVIDIA?
NVIDIA at about $4.5 trillion compared to the Russell 2000 small cap index at $3 trillion, which is really crazy. It's kind of mind blowing. Right?
Yeah.
So, I think if we broaden that and say, well, what's the concentration for the top 50 stocks in the S&P? I mean, that's near 60%. So when one participates in the S&P and thinks they're getting true diversification, they're really not, certainly relative to history. This is literally peak concentration levels, which doesn't suggest alarm bells, but what it typically precedes is a regime shift in terms of asset outperformance and relative performance. So think, again, kind of this theme of international that we've talked about now for 6 to 9 months.
Yes.
Very quietly, international assets on average are up 25% year to date, tripling the performance of the S&P roughly. It would be reasonable to assume small cap can show some emerging signs of strength in short abrupt fashion, as it's done kind of during COVID eras and in similar periods. So again, I think the message is, equal weight versus market cap weight. International, maybe relative to U.S. Again, I'm not suggesting the U.S. is going to roll over here, but thinking more broadly when one looks at a portfolio now more than ever makes a lot of sense.
We talk about the interest rate environment a little bit. Obviously, there's a lot of talk from every part of the political spectrum. Financial markets conversation. They're talking about the Fed.
Yeah, we've got Chairman Powell speaking at Jackson Hole on Friday of this week. That tends to create interested market participants and some volatility, perhaps. I think we've got the 10-year Treasury around 4.3%, give or take. It's very, very tame for the moment. I mean, we've talked about volatility around rates and inflation. I think that continues. We're seeing core inflation near 3%, which is higher than the Fed's target. There's a lot of political forces in play here for the Fed to cut rates in September. They probably do. Whether that's the start of this new cutting regime seems unlikely at this point. And, frankly, I think the administration has been outspoken about needing and wanting lower rates for home ownership and other purposes. And really, the only way that seems likely that we're going to get that is if we see some economic softening, which very well may be underway. We're seeing that a little bit with the job market. Too early to tell, but again, economic softening might be commensurate with lower rates, and that might be a growth scare that lies on the horizon.
And the stats just aren't dramatic enough to grant or warrant a dramatic drop in rates. Now, I think what's interesting over the last 5 years since interest rates have taken off, but really zero. There was decades where we sat there and tried to figure out a way to get income for our clients, and particularly ultra high net worth clients who need the income, and our retired clients who need the income. It's an interesting moment because it's nice to have yields.
It is.
Without having to take a lot of risk to get the yields.
That's right.
So for our clients out there who are retired or creating, pulling income up, their portfolios, it feels pretty safe. The last thing you want to see is just to drop interest rate dramatically.
Right. The cash flow component to bond investing is nice. And we haven't seen that. We've been in multiple decades of appreciation in fixed income as a function of declining rates. And we are in a different era. And I expect volatility to continue. I would just say as long as there's an orderliness, if you will, it's withstand higher rates, no problem. But, there's more supply coming onto the market. And, if we see runaway yields, that will inevitably create some friction with the equity market and valuation assessment, those types of things. But again, that's all a normal portion of the process. So, I think we're due for some of that.
Any other current topics that you're seeing out there when you sit with your ultra high net worth clients?
I mean, probably the most interesting one of the year was the tax bill was signed in on July 4th, really extending the estate tax exemption and gives them permanently. It starts now at $15 million indexed up. So for a married couple, that is $30 million that is not going to be subject to estate tax. That was set to go back down to roughly about $7 million per person, to about 14 total. We now have a whole group of people from a planning perspective that don't need tax planning. That shifts a lot of things on both charitable giving, wealth transfer in families, etc. But more than anything, it allows to keep wealth within the family. So multi-generational planning is still very important.
Great point. And I think, what I love to see when the big, beautiful bill came out, our tax team led by Ben Orrs and Matt Mercer, really did a great job breaking that bill down. And then our law team actually helping in terms of educating our advisors and our wealth advisors and our team to make sure that they can get that information to our clients as quickly as possible. Well, this has been a great conversation, gentlemen. So you appreciate it. Brian, welcome aboard. And for all of you, we appreciate you allowing us, Krilogy Wealth Advisors, to be stewards of your wealth. And as always, for John MacArthur, Brian Fernandez, I'm Ken Scornia. You have a wonderful day.